This is Andrew Stotz, and I'm going to go through another Valuation Master Class case study. The company is Kohl's, and the question is, will pressure on Kohl's management drive the share price? So let's look at this in more detail. Again, this is Andrew Stotz of A. Stotz Investment Research, and here you can see this is the Valuation Master Class case study, where we dig into interesting stocks and their valuations. Today's company is Kohl's Corporation. Remember that this video is for learning purposes only. It's not investment advice. So let's look at the company. Kohl's is a leading U.S. retailer with 1,162 stores and 12 outlets in 49 states. The question I have is trying to understand this company. The title for this is Growth Stagnation Hampers Value Expansion. There's three things to know about this company. First, strategic partnerships to escape growth stagnation. Activist investors increase pressure after poor performance, and a ramp up of share repurchases spices up returns. So analysts, there's about 22 analysts covering the company. And right now they have a 40% upside and a buy. The stock is trading on a PE ratio of 6 times and a dividend yield of 2.5. My estimate of value is about $59, and that's a 20% upside. If we look at the technicals, you can see that the share price has been pretty flat. In fact, the convergence of 50-day and 200-day moving averages really leaves kind of an unclear signal. There has been weakness in RSI, and maybe that comes back, but there's nothing that compelling in the share price performance. Let's look at sales and understand what's happening with the revenues of the business. And let's take a look. What do we got? So, revenue breakdown by product line. Well, the main product line is women's clothes. That's 24%. Home decor is about 21%. Men's clothes and also children's. And on the right-hand side of this slide, you can see that there's well-known brands and also exclusive partnerships. So what's the story here? That's the question. What is the story? Remember, if you have questions as I go along, just leave a question in the chat and I'll do my best to answer it. So Kohl's, the first thing is strategic partnerships to escape growth stagnation. Kohl's entered a partnership with the largest U.S. specialty beauty retailer, the Sephora. And I've never been in that store because I haven't been in the U.S. for a long time. I assume I'm pronouncing it right. The agreement moves Sephora's shops to Kohl's locations. And with 25 million customer base, Sephora could bring more traffic into Kohl's stores. I seem to recall that Kohl's is getting about 60 million customers. And then 200 Sephora stores already open with an additional 400 planned by first half 22. The partnership could bring Kohl's revenue back to $20 billion. Hillary, I see you say, I thought they owned TJ Maxx. Actually, let's just look back at that for a second. I don't have it listed here, but it's very possible. Now, here is the share price over time. You can see it's just really fluctuated around $50. Now, an activist hedge fund called for a split off of Kohl's e-commerce business, making up about 29% of revenue. That hedge fund values the e-commerce business as a standalone business more than the total market cap of Kohl's. It also suggested another way to unlock value by delisting Kohl's and selling it to private investors. Although unlikely to be successful, it increases pressure on management to improve the business to increase share price performance. Now, just to visit some of our questions that I've got. So first of all, nice to see you, Hillary. Hello. And also you said, is there any way of getting the live schedule ahead of time? That's what I'm working on. And I'll have something for you maybe in the next week or so. But it's taken me a little bit of time to get this engine up and running. So Abdul Qudus Mohammed, nice to see you. And I noticed that you're from Yemen. We have not had a student from the Valuation Masterclass yet from Yemen. I hope that you'll consider that. Now, let's continue on. And What's an activist investor? Well, an activist investor is an individual or a group of investors with a significant stake in a company who aim to influence or make material changes to how the business is run. Changes could be like board composition or pushing for repurchases and dividends, advancing some ESG issues, privatization, as we just saw earlier, spin-off of business segments, divestitures of inefficient segments. It doesn't have to be a huge investor. In fact, some of the activist investors that are very small can have a pretty significant impact. So it's not the first time that Kohl has been targeted. In early 2021, activist investors with around a 9% share aimed to take control of the company's board. Kohl's share price has chronically underperformed the market. And as a compromise, Kohl extended its board to include 2 directors nominated by the investor group. The investor activism appears to be a good wake-up call for Kohl's management to re-engineer its business. And let's take a look. And there's Kenneth Brown. Kenneth, nice to see you from Atlanta, Georgia. I flew into Atlanta a couple of years ago to see my mom and dad in North Carolina. It's been a while. And there is Kazars from Pakistan. Oh, I always wanted to go to Pakistan. We were trying to get me to go to Pakistan for the CFA presentations, but we just didn't get it done. So we got to do that at some point. Now, we will upload the slides on our blog afterwards. You can just go there and scan that QR code and get the PowerPoint that I'm presenting. Now, let's go through the FVMR scorecard. That's a scorecard that I've created. It measures a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. The scale is 1 best, 10 worst. And let's take a look. By the way, there's Kyle. Kyle, you're in Canada, right? I can't remember. Kyle is a master marketer. So here we can see the valuation. And what you can see is that the stock is massively cheap. Price to sales at 0.4, PE of about 5.9. But the question is, why is it cheap? Well, one of the reasons why it's cheap is because it hasn't had great profitability over time. And if that continues to improve, that could drive the share price. Now, recently, I created a short online course explaining my FVMR investing approach. You can get this $97 value for free. Just scan the QR code and go in and check it out. You'll be able to download PDFs of what I've got in there and learn about it, and certainly can ask questions. So let's talk about the forecast. Here you can see there's 17 analysts covering it, and they have an upside of 40%. But still, the analysts actually have a hold recommendation. That's not very common, where analysts have such a big upside. So what you can see is usually that happens when the share price is collapsing. And they forecast that increased profit margin is likely to fade over the next 2 years. And so let's look at this in a little bit more detail. Let's run through the P&L. First, we can see net profit has a strong rebound and exceeds its pre-pandemic level. The strong bottom line is mainly driven by the margin expansion that the company's had. Also, if we look at the balance sheet, this is part of why the activist investors are looking at this company, because they're sitting on about $2.2 billion worth of cash. And that is cash that these guys want distributed. When you look at the balance sheet, this is a very interesting company because the balance sheet is super clean. Look at the long-term assets of this company. Long-term investments, they don't invest in other companies, 0. The intangible assets, 0. Goodwill, 0. Other long-term assets, a small amount. So this really is all about the stores and the inventory. If you can figure out the stores and the inventory, you understand the assets. Now, let's look at liabilities. The company continues its massive share price repurchase program, which is main driver of increasing EPS. And you can see when you're accounting for a share purchase, it's a negative equity item. So if you're buying at a very high price, then as a negative equity item, it could get very big, and it's driving down the ROE of the company, and that's driving up the it's driving down the equity of the company, and that's driving up the ROE. This is kind of a manufactured ROE, and you have to be careful that a company's not just shrinking down its ROE. Now, one way to look at that is ROA, because ROA doesn't take into consideration any leverage factor. It's just the return, profit relative to assets. Nothing about how those assets are financed. So we'll look at that in just a second. So Here we can see the cash flow statement, and there's strong operating cash flow, and it allows the company to pay out the dividends. And also you can see it's been quite a bit of dividends that they've been paying out. And here you can see my revenue forecast of about 15% and then down to about 4.5. So really it's a recovery in revenue in 2022. By the way, I noticed Kenneth Brown. Kenneth, you're in Atlanta. Have you ever been to Kohl's? I have never been to Kohl's. I left America 30 years ago, so I really haven't seen it. But I've never been. Have you? All right, let's look at the EBIT margin. You can see the EBIT margin went up from almost nothing, of course, in 2021, which was a bad year. And then it's now up to about 9.5. Now, the average EBIT margin of all companies in the world is about 10%. So at 9.5, they're doing pretty well. And that's starting to come down. That's some of my expectation. Let's talk about valuation. And we'll talk about valuation in a second. But Kenneth, I want to know, did you like it? What's it like? Kenneth says that he's been there. Anybody else been to Kohl's? Because I haven't been to Kohl's. It looks interesting. So that's the cool thing about valuation. We can look at any company. Now, this slide is the most important slide. I've been developing this slide over the last couple of weeks to try to explain, could this be a 10 bagger? In other words, could the share price go up by 10 times over the next 5 or 10 years? And the way to understand that is that that would only happen if earnings accelerate a lot, or if the price, the PE, the multiple expands. So what are the drivers of earnings? Well, first, it's price times quantity, in fact. And we can see that retail price, we're going to assume, are pretty flat. So weak potential for them to really increase price over the next 5 years. And quantity, weak, no massive store expansion plan. So it's not like they're going to grow massively at the top line. What about cost of goods sold? Well, the margin already is pretty good, so it can't expand that too much. And then OPEX, the amount of spending it has, technology could lead to slight improvements. So there is some opportunity. But I would say based upon that, EPS growth is really only going to be driven by share repurchases and maybe a 5% or so over the next maybe 5 years or so. Now, Kenneth, you made me laugh. Kenneth, you're making me laugh. Kenneth says, my wife hasn't been there in years, though. Well, that's good, because that's going to save you some money. So, so let's look at the next thing is, could this company be so cheap that the multiple could expand and it could go up? Well, the PE multiple, there's some potential there. You can see I've rated it as a good potential. It's cheap versus the U.S. consumer discretionary at about 6 times. So there's opportunity in multiple expansion. And also in price to book, there's opportunity in multiple expansion. If we want to talk about a company going up by 5 or 10 times, we've got to see earnings growing and multiple re-rating. And we don't see that here. So I wouldn't say that it's a lot of opportunity to see this company go up by 5 times or 10 times. So let's go through and look at the cash flows. Here we can see that free cash flows are pretty strong, and the company has a strong earnings ability. And now let's go into my value estimate. Like consensus, we expect a slightly stronger margin compared to the past. The revenue growth CAGR is distorted by the growth rebound in 2022. So we kind of have to look at it, but I would say generally on a long-term basis, we're probably talking about 5 to 8 or so % revenue growth over the next 5 years or so. I've looked at it on a free cash flow to the firm valuation basis. You can see my assumptions there. A weighted average cost of capital of about 9.9%, cost of equity of 13, terminal growth rate of 2. And based upon those assumptions, I get an upside. I get a base case of about 59 baht or $59 and an upside of 20%. In the bull case, I could get that up to about $64. And in the bear case, it's probably going to come down to 55. So I think the summary is that I don't think this stock has a chance to go up by 5 or 10 times, but there is upside there. Now, let's look at the world-class benchmarking scorecard, because remember I told you that if we look at ROE, it can be distorted if a company's reducing its equity through share repurchases, right? And now let's go ahead and look, right? And basically, this company is now ranked number 2 in the past 12 months against 1,040 large consumer discretionary companies worldwide. That's a fantastic recovery and a good result. So from a fundamental perspective, they're doing pretty good. And we can see that their profitability is ranked number 3. 1 is best, 10 is worst. Number 3 is very good relative to 1,000 of its peers. And then number 1 on the growth side shows that the EPS growth is actually pretty strong. Now, let's just take a moment and look at return on assets, ROA. That's the profitability measures that I show in the bottom left, where it shows the past 12-month performance is a ranking of 3, meaning above average by about 2 points. If it was at 1 or 2, it would be world class. But the point is the company's ROA is pretty good. So ROE is pretty strong and ROA is also pretty strong. So it's not, the ROE is not that much distorted by what's happening with leverage. Let's look at the risks. Well, activist investors might not decide in favor of the long-term future and try to take some short-term profit. Increased transportation costs and worsening of inventory management is definitely a risk. And failure to keep up with e-commerce could lead to a loss of market share. So there's my conclusion. The Kohl situation is interesting. The conclusion is don't expect high growth, but price discount offers upside. So there's still upside. It's probably not going to come so much from the earnings growth. Intervention of activist investors could be accretive, and attractive dividend yield and share repurchase program can be satisfying enough. So I ask you, will pressure on Kohl's management drive the share price performance? That is my summary of the case study of Kohl's Corporation in the US. If you have any questions or you want to learn more, feel free to post and share. Also post in the comments and I'll do my best to reply. And again, if you want to check out that short course, I'll go back and put up the QR code. It's a good little course and you'll learn a lot from it. So I'll just put it up there 1 second. There. This is my FVMR course. And basically it just explains how I develop and how I use FVMR so that you can use it in your own investing. So feel free to go to that and check it out. I just want to thank everybody. I want to thank Kenneth. I want to thank Hillary also on the call. Hillary in Nigeria, Kenneth in Atlanta, Georgia, Kyle's in Canada, and Kazar's in Pakistan. We've got Abdul Kudas in Yemen. And it's great to meet all of you guys. Keep rocking. Have a wonderful day. It's about 8 p.m. here in beautiful Bangkok, Thailand. So I'm going to sign off and I'm going to go relax, watch a little Netflix, and have a great evening. Thank you, Kenneth. I appreciate it. And thank you, Kyle. Hopefully, Kyle, we'll talk on LinkedIn a little bit more. We haven't talked for a while. Hillary, miss seeing you since I'm not on Facebook anymore. I always enjoy seeing your posts and the smart things that you say. So anyways, you guys have a rocking day.